Hi there, it's Gavin Park at Premier Financial Planning here. Today I'm talking about the tax-free lump sum from your pension. Now the very first thing to say is that there are some very significant differences with your lump sum between drawdown and annuities. And the focus of the short video today is really to focus on that and explain the differences that there are between drawdown and annuities with your lump sum. So firstly, let's have a look at annuities. Now the first thing to say is that the standard amount of lump sum from your pension is 25%. There are some pension scheme regimes that you have a slightly higher tax-free lump sum, so it's always worthwhile making sure that your pension is analysed to see if you do have what's called reserved tax-free cash rights or not. But the standard we'll work on today is 25%. So with an annuity, you're purchasing an income for the rest of your life. So when you actually come to purchase the annuity, you take out the 25% tax-free lump sum, and the remaining pension pot then purchases an income for the rest of your life. Now the unfortunate thing with annuities is that they are quite inflexible with your benefits and including the lump sum. If you want to take that lump sum, you have to take it at outset. If you don't, it is effectively lost. What basically happens is that 25% forms more of the annuity, so you purchase a higher amount of income, and that will provide income for the rest of your life, but it will lose its tax-free status, and that will then be taxed at income tax rates. Now, the very unfortunate thing is let's say you're in a scenario where you actually want to release the tax-free cash for a reason, to give a deposit to one of your children, or to pay off some debts, or to do some work on the house, but you don't want the income. Now, if you're in that sort of situation, if you go down the annuity route, you are forced to purchase the annuity at that point. You can't defer it. And therefore, the income will actually be based on your current age and health. The other unfortunate thing with annuities is the fact that once it's purchased, you cannot change it. Therefore, you will be forced into the annuity rates at those rates, and if you are younger for retirement, that can have some detrimental effects later on. With drawdown, things are actually very different. The tax-free lump sum is the same standard 25%. However, you do not have to take the lump sum all in one go. Again, this depends on your objectives. So again, using the same scenario that you wanted to release the tax-free lump sum but didn't want to take income, you can actually take it in whatever sort of permutations you want. So you could take 5% now, you could take 5% later, so on and so forth, until the whole 25% is actually used up. And how that works is each time you take some of the tax-free cash, you are crystallizing, which is what HMRC deemed the word to be, part of your pension. So you can crystallize part of your pension in stages. And as I said, there's no restriction on how much or how little that you do take. The great thing about this is, you're not forced to actually take any income from it either. The one thing I must actually state is, if you do want to take income from your drawdown, if you're going down that route, the income can be restricted if you only take part of the tax-free cash, because you can only take income from the amount that is crystallized. So if you've only taken 5% of the tax-free cash, it will only be a small pot that you're actually taking the income from. You'd have to release the rest in order to take a higher level of income. But using the scenario we were talking about earlier, about just wanting the actual lump sum and not income, drawdown can actually add some additional sort of flexible advantages. Now that lump sum, if you don't use it all, so let's say for example you've only taken say 10% of it, the remaining 15% will actually grow in line with your pension. It won't just stay as static. It will still be ring-fenced, but it will actually be the higher amount over time that you can actually take. So if that grows from 10,000 up to 15,000 due to the growth over time, then it will be the 15,000 you could take out tax-free. Of course, the converse is true if your pension does fall in value. As I stated earlier, when you take your lump sum, there is no need to take any income from the drawdown. So the great news about that is you can actually allow the pension to grow. You don't have to sort of whittle the pot down by actually taking income. You can set that at 0. So what we're finding with many clients is when they're wanting to release their tax-free cash, they can do that via drawdown. They can continue the pot to actually grow in value. And the aim of that is then to actually provide them a higher amount of income when they actually finally do give up work and when they do want the actual income at that stage. And the other really great thing about drawdown is it's very flexible. You're not tied into it. If you still want to purchase an annuity at a later stage, you can do. But because you are older and potentially you may be in worse health, then you may be able to get a higher annuity rate as well. So in summary, regardless of your lump sum, with annuities, if you want the lump sum, you have to take it straight away or that lump sum is lost, and so is its tax-free basis. You have to take income based on your current age and health, and with no chance of deferring it if you want that lump sum. On the other hand, with drawdown, you can actually choose how much of the tax-free lump sum to take, and the remainder stays in your pension and it continues to grow. And then you can actually take that out whenever you actually desire, maybe that be 2 months, 6 months, 5 years, however long. You don't have to take any income so that you can actually defer it, which can actually allow that pension to grow. And then at a later stage, when you actually do want to take income, you can either use the drawdown account for that, or you can purchase an annuity, which potentially can give you a better annuity rate because you're older. Now, next steps. Now, if you are looking to take the tax-free lump sum and defer taking income, then drawdown can actually be a very good solution for that. Now, the key things is actually to make sure that you've got the right drawdown provider, the right investment portfolio within that drawdown to match your objectives and circumstances. And that is based on many things, including what the objectives are, what your risk profile is, so on and so forth. We always recommend advice should be sought on this. And today what we're going to offer is actually to take advantage of our free personal provider comparison report. Now, this report, for free, basically takes your situation and actually shows you the actual provider options for you. So therefore you can actually have more of an in-depth look on actually what providers will provide for you and the benefits and disadvantages of both. All you need to do is on the website, there's a button to click and a quick form to fill out, and one of the advisors will be in contact just to talk through your circumstances so we can gather that information and actually provide that report for you. Now, that's basically the video finished on the actual lump sum, and I hope you got value from that. Now, this page, being it's a regulated business, it's regulated information, this is all the sort of risk warnings and important information. And one thing to really pull out of this is this should not be seen as personal advice. And if you do want to, if you don't understand any of the contents on here, we do recommend you seek independent and financial advice, and that's something we can offer to you. Okay, I hope you enjoyed that, and thank you very much.